that's all good for gold. Everything that is driving bonds down should be driving gold up. Well, soon they're going to have to reprogram them, especially if today's action means that we have decoupled, because instead of going down, gold is up. Now, it's not a huge move, but it's still a move. Gold's up about $7. Now, the initial reaction, right, is soon.
In this video, Peter Shciff discusses an intriguing market anomaly, focusing on the surprising behavior of gold in the face of strong economic indicators. He challenges traditional beliefs about gold's performance in good economic times and explores the changing dynamics between gold and bonds. Peter suggests that the traditional correlation between rising bond yields and declining gold may be shifting, with gold potentially rising alongside yields. The video underscores the importance of understanding the complex interplay of economic factors in today's markets. So stay tuned till the end.
We've had a 5 handle on a 30-year Treasury since 2009, and it wasn't up there for long. But this is a big deal that we have 5% interest rates. Now, again, I've been predicting this. Most analysts, including the bond specialist, they didn't think this was even possible. There was no way they thought we can get up to 5%, yet here we are. And we're not going to stop here, because remember, you can get 5% on a 6-month bill, or 5.5. So why should you settle for 5 on a 30-year and take 30 years of risk? So we're headed for a 7 handle, as far as I can see. Well, obviously we got to get to the 6 handle first, but I think by next year, unless the Fed panics, we'll have a 7 handle. But even if they do panic, we're going to get there anyway. It may just take a little longer, but there's no way for the Fed to stop this. It's like, it's like King Canuck and the tide, right? You can't yell at the tide and stop it from coming in. This is going to be a massive flood, and there's no way that the Fed can hold back the deluge. Long-term rates are headed much higher. Yes, they were able to artificially suppress them for a lot longer than I thought, but those days are gone, right? Inflation is out of the bag, and you're not going to get it back in. There's no more 2% inflation. In fact, I even heard some rumblings this week from some Fed officials, I don't know, taking a look at that. There's starting to be a little crack in the idea that we're going to get down to 2%. But 5% is a big deal. 6 and 7% will be even bigger deals. Look at the 10-year U.S. Treasury. It is yielding 4.828. The high water mark earlier this morning so far was, 4.828. The high water mark was 4.887. But again, this is the high we've been for this cycle. We'll be over 5% on the 10-year shortly. We haven't been above 5% since 2007. And then we just barely peaked our head above 5%. It didn't stay above 5% very long. It was kind of like a spike. But this is just a stepping stone to much, much higher rates, because we have a far bigger debt problem. In fact, that debt problem looks to be spiraling out of control. So this is a big negative. The markets are just whistling past this graveyard in not appreciating how much has changed and why stock prices have to be a lot lower, unless investors still don't believe these interest rates are going to stick around. They still believe the Fed's going to slash rates back down near zero. And so they're not factoring this in as a long-term situation. They just think it's a blip on the radar, and it's just a little detour on the road back to 0%. The markets are wrong. The markets have to come to terms with this, and that means lower prices. But the most interesting market reaction is not in the stock market, but in the gold market. Because you would have thought, again, that gold would have been clobbered today because of the strong economic numbers, which have traditionally been bad for gold, because gold is supposedly something you buy when times are bad, not when times are good, and job creation is supposed to be a reflection of good times. But also, gold has been trading with bonds. Bonds down, gold down, because the algorithms look at rising yields as being bearish for gold. Now, I think they're bullish. I've been saying this all along, and I expect a decoupling from bonds and gold so that they go in the opposite direction. Bonds down, gold up, meaning gold rises as yields rise. Because why are bonds going down? Inflation. They're going down because of a loss of confidence in the U.S. government's ability to handle its debts. It's because the deficits are spiraling out of control. That's all good for gold. Everything that is driving bonds down should be driving gold up. That's just what the programmers of these algorithms didn't understand. Well, soon they're going to have to reprogram them, especially if today's action means that we have decoupled, because instead of going down, gold is up. Now, it's not a huge move, but it's still a move. Gold's up about $7. Now, the initial reaction, right, as soon as the number came out and bonds tanked, gold dropped $10. So that was the initial knee-jerk reaction, was a sell-off in gold. Now, bonds have rallied from their lows, but they're still way down. On the other hand, gold has actually reversed, and it's gone from $10 decline to a $7 rise. Now, it's still early in the morning, so maybe this can turn into a bigger rise for the price of gold. Gold stocks, though, are up about 1%, and they've been strong. They were strong yesterday, even though the price of gold wasn't. So the gold stocks may be leading the metal higher right now. What would help would be a reversal in the dollar. The dollar index is still positive on the day, although it was down yesterday. We're below the highs for the move, and it looks like we're in the process of rolling over. The dollar index, as I'm doing this podcast, is 106.575. But if we reverse and end up finishing the day negative, that could also confirm that we have a reversal in the gold market. Also looking on the weeklies, both the gold chart and the dollar chart, to see if we can get any kind of significant weekly reversal. I'll be able to comment on that. Markets, so, are continuing to recover as I'm talking, and now the NASDAQ has climbed into the black. It's now up almost 0.2% as people are buying these tech stocks. Even the Dow now is only down about 53. So again, I think it's because people are betting that maybe this is it, that 5% was all we had to do. In fact, what a lot of people are now saying, and I heard this refrain quite a bit yesterday, is that the Fed is probably done hiking, that there's no more hikes. I know the Fed was talking about an extra quarter point, but what everybody is saying is that given how much bond yields have risen on their own, that basically is equivalent to another quarter point. And so the Fed doesn't have to hike because the markets have tightened for them. And maybe that is the case. Maybe the Fed is going to back off because, again, the Fed does whatever the markets expect. And so if the markets expect that the Fed's not going to hike anymore, if that's what the probabilities show because they think they don't have to because the market did their work for them, then maybe there won't be a hike coming up. How everything settles up. But this is just a pit stop in the bond market. If you think that we're done at 5%, that we finally achieved something because we got to a 5 handle on a 30-year, and that's kind of like a blow off top, and it can't go any higher than that. Believe me, it can and it will. 5% is still a low yield based on modern history, but we shouldn't have normal yields. We have an abnormal amount of debt. The level of debt and the trajectory of the debt call into question our ability to repay it with anything but hyperinflated dollars. And so the U.S. should pay a substantial premium to borrow money honestly, which means we can't have historically normal interest rates. We have to have historically high interest rates. And historically, interest rates have been a lot higher than they are now, even when we were in a much better fiscal position than we're in now. So we're in for much, much higher interest rates, far higher long-term bond yields, a much steeper yield curve, but it's happening at a time where we've never been so leveraged. We have more debt, and now we're about to have to pay more than ever to service that debt. It is impossible. So either we have to have massive defaults or massive inflation. But one way or another, these losses are going to be huge. The only way to avoid these losses is to avoid the dollar, avoid U.S. debt. Again, call up Shciff Gold, get yourself some gold and silver before the explosive move up, and talk to the guys at Your Pacific Asset Management about reallocating your portfolio, getting out of overpriced U.S. stocks, getting out of U.S. debt instruments, and getting into foreign dividend-paying value stocks and the type of companies that will do well with stagflation, and in particular in an environment where the U.S. dollar is crashing and the U.S. dollar is losing its reserve currency status, where the U.S. is mired in a recession, depression, banking crisis. There are companies around the world that can still do well in that environment, provided that the dollar is falling, because the falling dollar provides tremendous relief for consumers and businesses outside the United States, and that should be reflected in higher asset prices.
Peter Schiff's insights in this video provide a unique perspective on the ever-evolving world of financial markets. He challenges established norms and offers a thought-provoking analysis of the relationship between gold, economic indicators, and bonds. As the landscape of the market continues to shift, Peter's ideas encourage us to question conventional wisdom and consider new possibilities. Like this video, subscribe and press the bell icon for more videos. Thank you.